I'll pass it over to Tim and let him take it away. Thank you.
Okay. Well, thanks, Don. Hi, I'm Tim, and I see a lot of familiar names in here, some of which I saw just an hour ago in my Thursday group. Um, at least one of whom sent me an email and also put a question in the chat, and I'll try to get into that. And a bunch of people whom I don't know as well. And so it's always fun to talk with you guys. I think you're wonderful options traders and have a wonderful group here and great subjects and great discussions and even great write-ups after the fact or about other things. I've been able to see some of the write-ups that some did and still use it for reference actually. So um, today I want to talk about the Boxcar Trade. This is basically another Dan Harvey trade. He set it up, did all the testing, developed the criteria. It's a variation of a condor, and I'll show you all that. And then on Aeromir, Amy Meisner ran a service trading the Boxcar, and these are educational services. So, one of the things that we do in the service is to every time I make a trade or an adjustment, I send out a thing that says, here's what I did. And then you usually write up some kind of reasoning why I did it and all that. But this isn't about the service today. I'm going to talk about the Boxcar trade itself and how I trade it. I don't have a lot of slides to show. I have a few, which I'll do right away. And then I'll use Thinkorswim to show you how I do the trade and how I do my adjustments and some of the things I think about on this trade, okay? And, you talk about having traded a lot. Yeah, I just looked in my trade log where I track every single trade that I've ever done since 2009. And there are 2,498 of them today. And out of that, I think, if I remember right, 38 of them are boxcars since I started trading the boxcars. So that's kind of my experience with the boxcar. We have traded them in two different ways. I call that version 1.0 and version 2.0, and I'll show you both of those. And with that, I guess I'll just go ahead and get into the slides. Give me a second because I have to load. See, I have to stop the share. Oh, disclosure. I do need to do disclosure. So let me do that real quick. You've all seen this before, but Aeromir is not a broker-dealer or securities investment advisor. I am also not a broker-dealer or securities investment advisor, and so there are no trade recommendations made in this session. Everything you see here is for educational purposes only. Options involve risks and are not suitable for all investors, and you always trade at your own risk and make your own trading decisions. Past performance not indicative of future results, and you can pause the recording and read the rest of the fine print. Okay, pretty much have that memorized. Let me switch now to where my slides are. 1 second. I was looking for a good way to kind of compare a boxcar with a butterfly. And I think I came up with a good way to do that. And I want to share that with you to start with. Okay, so here is where it starts. Slideshow. Nope, that didn't work right. Okay, hold on. Oh, I see why that didn't. I see why that didn't work. Hold on. 1 second. Here. There we go. It's a simple slide, but I was trying to do a comparison of boxcar with butterflies or broken wing butterflies or whatever. And it's hard to do because there's many different possible configurations of butterflies. There's road trip style, there's Dreamlifter style that Dave's doing, there's what he calls flex now, there's broken wings, there's balance, there's unbalanced, there's all kinds of stuff. So for this comparison, I picked one that was reasonable, okay? It isn't any particular strategy, but it was reasonable. And I have a slide to show you about that. But as I go through those slides, watch the initial position delta of the comparisons. And in particular, I want to talk about the effect of the debit spread component of the butterfly and the boxcar, okay? So here's the first slide. Okay, get that off of my screen, okay. This is a boxcar. I just made this up. I haven't done, don't make this trade. It's not a recommendation, but I did this earlier today. And I just used general top level guidelines for setting up a boxcar, which is the debit spread component is ideally straddling the money, maybe just out of the money by one strike, something like that. It should be very close to the money. It shouldn't be all the way in the money down here. It shouldn't be out of the money, sorry, in the money up here, out of the money down here, because for hedging purposes, which is what the debit spread component of the boxcar does, for hedging purposes, a debit spread works best when it straddles the money or it's just slightly in the money. And there's a lot of reasons for that, but it's basically that's where it'll kick in as the market goes down the fastest in terms of becoming profitable. Okay, so this is a generic boxcar, and then down somewhere down below it is the put credit spread component of it. And note that this is a condor. It's a four-legged condor order, and a condor is simply a butterfly where the shorts are not at the same strike. If this short was the same strike as this short, it would actually be a butterfly and you know, fall under the butterfly rules. Okay, and then to compare it with, I made up a butterfly. Now this is similar to the way we did the road trip in that I placed it just out of the money, just above the top long of the butterfly. And I placed it broken enough such that the top wing was above zero, okay? In an ideal world, if you did these, that would be a pretty ideal way to do it because then there's no risk to the upside and you just have to manage the risk to the downside. But I chose this particular one to be an example, and I chose it so it has the same margin as the boxcar did, $1,000. And I wanted to see what how these two compare, you know, which one is better, which one has less risk, which one has the debit spread closer to the money and which one doesn't, and how much difference does that make? So that's what I'm trying to show you here. So before I get to the last slide, I want to load these up in Thinkorswim and show them. Here's the boxcar component, and I want to look at just the debit spread for a second. When I did this, it was still kind of straddling the money, but think about it this way. The only reason you put a debit spread on a boxcar, or the only reason you have longs on a butterfly, there's only one real reason for that, is to control margin and control your risk, right? Because if you didn't do that, you'd make actually more money by just doing the credit spread, you know, $200 in this case. Well, here, it could make more than that, but it never really does realize that. And to the upside, we have work to do to get this line raised. And so $200, it might not ever reach that, you know, if we trade it reasonably by the guidelines. So the reason this is there is to hedge a little bit against a downturn. Same with the butterfly. So let's look at just the hedge component, which is the debit spread. If the market went down by June 3rd, which is a week from today, let's say to 41.60. I'll just be brief on this. Well, this is showing that the debit spread component would be $426 profit. Okay, right here. Well, what about the butterfly? Well, I need to work this up first, so let's just build the debit component, and that debit component is 4200/4190. So let me adjust the strikes here. There is the debit spread component of that butterfly, okay? If the market went down to 41.60 by June 3rd, it's reading $335 on the T+7 line. Okay, getting older, I already forgot. This one's 426. So this underscores what I just said, is that the debit spread closer to the money is going to kick into profitability faster than the debit spread that's out of the money. Now, I make this point because this is why I say the boxcar is probably a little bit less risky than the butterfly is, margin for margin and all. because this hedge kicks in sooner. And most drops are not suddenly 100-point drops. You know, it's happened, I think, twice that I can think of in memory at all. And those were only in the last couple of years. But most of the time, there's either, 30-point drop gap or something, or over a couple of days, it'll go down 30, 40 points and then stabilize and go back up. What that means is this debit spread is going to kick in before the put credit spread part loses a lot of money. In other words, this trade will benefit from that. The butterfly, we go down 30 points or so, that is here. The put credit spread part is losing faster than the debit spread part is winning, at least for that much of a point move. This particular butterfly, they're all different, but I think I made my point. So if you compare, I'll go back to my slides, if you compare those two graphs on an equal basis, I tried to make a superimposition here on the slide, and that's this slide right here. I tried to align the horizontal axis and I tried to align the vertical axis, and you can see the butterfly has a higher peak, but over a much narrower range. The boxcar being condorized has a lower peak, but over a wide range. It's flat, and that's an effect of condorizing a butterfly. And I know it's hard to tell, but this line is the T+0 line for the boxcar, and this is the one for the butterfly, okay? So by June 3rd, which is actually T+7 today, T+0 on June 3rd, the boxcar is going to handle a downturn much better than the butterfly will. Now, conversely, if you watch this line, to the upside, the butterfly is going to handle it a lot better without adjustments than a boxcar will. So there's always a trade-off, but if we're trying to have a trade that's safe against a drop in the market, the boxcar, I believe, is safer than most butterflies. Okay. I see your comment, Mark. I think you're talking about in toss, and yeah, I probably did, but in here they're not. In here they're not locked, and they're all just superimposed. The two graphs are superimposed on each other. Okay, enough of that. Let me go to Thinkorswim and go through setting up a boxcar here. Clean up some stuff. Okay, so I'm gonna just start from fresh. Now, Dan Harvey has talked in detail about this entry criteria in Trading Group 1, and I've talked to him personally about it, and I think he's talked about it in the service when Amy was doing it. So the basics of the boxcar and the entry and the criteria is all public knowledge, which is fine. I think it should be. This is educational, and that's what we're trying to do is show you or teach you how the trade works. So when I go work up a boxcar, first of all, I'm usually doing between 10 and 20 days to expiration. Last one was 7 days to expiration. That can also work. 4 days to expiration, I tried once. I had a really tough time with that. And of course, you all know the reason is, if you want to have a put at 20 delta or something, if it's 4 days to expiration, that's a much higher strike than if it's 10 or 15 days to expiration. That's one reason right there. So it's a thinner trade and therefore not as safe. So I wouldn't do them much less than 7 days. But let me, okay. Hi, Tom. I see you. Oh, that was a direct message to me. Yeah, okay. Wants to know how I superimpose those two graphs. I'll show you that. It's not toss. It was a trick, but I'll show you that. Well, let me work up a boxcar first, okay? And I'll come back. Okay, so let's say I was going to do an 11-day to expiration boxcar, 7 June. The first thing I'll pick is the debit spread at the money, which is 4,200 right now. So I'm going to pick a 4205/4195 10 wide debit spread. Why did I pick 10 wide? You know, you can pick almost any width you want. I've been doing them lately, only 5 wide. Earlier I did them 25 wide. It all basically comes down to how much margin you want to put in the trade. By making them thinner, you can control the margin. And this trade scales up pretty easily directly. So if I work up a 1 lot, but I want to do a 5 lot, just multiply by 5. I mean, not all systems scale up like that, but this one does scale up pretty well. Okay, there's my analytical debit spread. Now let's figure out where the put credit spread might be. And I simply start by picking about 19 or 20 delta. Okay, it's only a starting point. There's 20 delta, so let's pick the 4130. And this also will be 10 wide. And I start with 2 of those to 1 of the debit spreads. This is my basic boxcar entry. I take this and I do my analysis on this and then decide if I need to tweak the strikes or change the ratio. This is a 2-to-1 ratio, and we'll talk about that. Okay, Boxcar 1.0, what I used to do was we're looking for a hedge. We're looking for the put credit spread to pay for a good percentage of the hedge. And we're looking for it to be safe, far enough out of the money to be safe. And we're looking for the hedge to be profitable enough on its own to offset a lot of the loss in this area of the trade. Okay, so you can see right away that the put credit spread by itself would make as much as $190. The debit spread by itself would cost $340. Okay, so what is that ratio? I call it the CD ratio. There's various other things, but this is probably the most critical entry criteria. $180 divided by 340 is, get my calculator out, 0.52. It's, Dan determined somewhat empirically what he wants that ratio to be, and 0.52 is a little bit low, so we'd like it to be 0.6, 0.7, a little bit higher, which means if I want to meet that criteria, I need to adjust the strikes. I either lower my debit spread so it's cheaper, or I raise my credit spread so it's more premium. Usually what I'll first start to do, since this was at the money, I'll take it down 1 or 2 strikes. I wouldn't go much further than that, but you can see the price, I lowered it by 5 points, and the price came down from 340 to 310. Now, if I do that ratio calculation, it's a higher ratio. It's 0.58, not quite where I want it. So let's raise the put credit spread a little bit, 5 points, let's say 25. Okay, I think we're going to meet the target here. 210 divided by 310. Yeah, 67%. So that meets that criteria, which is probably the single most critical criteria to meet. All right, now I look at how far below 0 the upper line is, because as the market goes up, I'm going to have to adjust this line. And the upside spread, which I'll talk about more in a minute, is to peel off some of these debit spreads, okay? That means I have to raise this upper line by at least $100 to get it to 0, and probably 200 to get it to where I have a reasonable profit. That means if I only have a 1 lot debit spread, I have to sell it for $2 or more to do that, okay? That pretty much right then tells me the adjustment point, but we usually choose it by looking at the day steps on here. But the adjustment point will be whenever this quote's at $2 or so. Not later than that would be when I want to make that adjustment. However, I can't peel off a 1 lot debit spread, because if I did, I'd have simply a put credit spread left. So this trade should be made with 3 or 4 debit spreads total. So I'm going to change this to 3. That means this would be 6, so I still have a 2-to-1 ratio. It's the ratio of the lot size of the put credit spread to the lot size of the debit spread. And now if I peel these off, I can peel them off one at a time. I have to now get at least $300, but it means I could peel them off for as little as about $150 each, $1.50 each, to be able to make that work. All right. See, Stephen asked what ratio. So that was one ratio, the lot size, but I suspect you're asking about the CD ratio. So I'll review that. The CD ratio is the maximum profit that the put credit spread can make. In this case now, $630. Reading that right there. Divided by the total cost of the debit spreads, which is in this case $930. So 630 divided by 930 is 67%, and it would meet the criteria. Okay. Basically, that's entry. Now, what I'll always do is I'll say, well, this is a 2-to-1 ratio. How about a 1.7 to 1 or a 2.3 to 1? So I'll try by changing these put credit spreads size to see if things still work. Okay, and I'm just calculating the ratio again. Now I only have 525 divided by 930. And that's only 56%, so I can't, this doesn't work. If I made it 7 lots, I have 735 divided by 930. 79%, that might be okay. And I have sold more premium, so this might make a little bit more profit. It takes more margin and, you know. So let's run with this. So after all that analysis, there's a few more things we typically look at, but this is basically it. I would make the decision that this is a boxcar I want to do. So I'll lock these prices in and we can go forward from here. Now, where to make your upside adjustments and your downside adjustments. Let me talk about that for a minute. Dan is the pioneer of using the day step curves, which is a convenient way in TOS to look ahead several T plus Ns at once. So let's change this to day step plus 4, and I'll change this step size so that my furthest out date is not past my expiration date. Okay, right now it is, so the seven per step is too much. We'll come down to 2. So each line here is 2 days apart. It's T plus 2, T plus 4, T plus 6, T plus 8. To the upside, I want to be able to sell these debit spreads with enough credit so I raise that line far enough to make money if the market stays up there. But if you just look at the day step curves, you can easily see up here is kind of too late. I can't, they've already conflated with each other. There's no profit from day to day here. So what we do is kind of eyeball this and pick a point before that, but not so far down as it still has a big difference day to day. And I usually pick somewhere around in here, and I'm looking at the red line, which is May 31st, which is, how many days is that? 5 days from now, 4 days from now? And I'm gonna say, well, that's where it starts to get bad fast, and that's at 42.15 or so. So I'm gonna probably pick my first adjustment point to be 42.15, my first upside adjustment point. To the downside, something similar. I want to make my adjustment before these graphs fall off very much. And I want to look at either the turquoise one or the red one here, and they start to fall off about here, which is 4170, we'll call it 4175. I want to make my first downside adjustment here before the P&L withers away or I lose too much on my P&L. So 4175 and 4215, okay? So if I go back to my expiration graph, here's 42.15. You can see we have some room to go up about 15 points, and it turns out that's typical. 15 to 20 points to the upside before the first adjustment. That's typically where it turns out to be. And 41.75 would be about here. That's before the T plus 0 line even starts to tail off very much. Now, chances are I would bump it up a little bit, probably to 41.80. I don't want to even let it get bad before I start peeling it off. And yes, I'm ignoring the IV spike impact on the downside. The numbers will actually be worse than this. And that's another reason why I would come up a little bit from where we picked from the day step curve. So 4180, maybe even 4185. Now note that that is about 20 points. And I find typically that's usually where it turns out to be, 20 to 25 points on a trade like this. So at least in these market conditions. My last several boxcars, that's about what it's been, about 15 points on the upside, 20, 25 on the downside. Okay, so what do? Let me put a price slice here at 42.15. And let's take a look at the upside adjustment. Price slice, are you gonna do it? It's not doing it? Okay, why isn't it doing it? There it goes. Okay. It says I'd be down $38, okay. Well, the adjustment is to remove a debit spread. So I'm gonna sell one lot of the debit spread. Now I know this price isn't accurate because it still thinks it's currently here, so I'm gonna make an estimate. If we've gone up, that debit spread will be losing money, and let's say it lost about 90 cents. So let's just say I could sell this for $2.20. Okay, well that adds $220 credit to the top expiration line, which in this case raises it just above zero. Gets my delta more closer to zero. Now I have no risk to the upside, but also not very much profit. So if we go up another 20 or 15 or 20 points, which is usually where it happens, then I would take off another debit spread. And I'll just estimate that. Again, it'll be higher. So let's say I get this one for $1.50. Just estimating. Now my line is up even higher. It's up $175. The profit target for a boxcar is 5 to 7%. And if you have to make adjustments, I usually lower that to 3 to 5%. And then the second adjustment, 1 to 3%. And after that, I usually don't stay in it if it takes more than that. So this was originally a $4,000 margin trade. 5% of that is $200. Well, this can't reach that, but I've made two adjustments. So if I lower that to 3%, that would be $120. And now I have a good chance of that with that line at $175. I might not need to make any more upside adjustments. Okay, does that make sense? I hope. I know I'm doing this really fast because I'm gonna run out of time if I don't watch it. So I'll keep going here. Let's talk about downside adjustments for just a minute. It's the same idea. We're gonna peel off some of these put credit spreads. Now, where did I say it was? I said it was 41.80, I think. So let's put a price slice there. And let's look at the impact of taking off these credit spreads. You would take off, at least I take off one lot at a time. So my first adjustment point, I take off one lot. And the market will have gone down, which hurts a put credit spread. So it's going to cost me more than I sold it for. So let's say I am able to take this off for $2. Okay, that's a bit of a loss. But you can see what it does to the delta. I have negative delta, and before I made that adjustment, I had positive delta. So it lowers the break even, gives me more room to the downside. It makes this upper line go further below zero, but we're under the tent here, so at least for a little while, I'm not too worried about that. And we're ready to go. If it continues down, I take off more, and usually it's only like maybe another 10 points, maybe even less than that. So let's say we get to 41.70 and I take off another one, and it's going to be worse. So let's say it's now 250. Okay, note again, I have negative delta, further room to the downside, worse up here, but I've made this trade more safe, and I'm in a trade that still has profit potential because we're under the 10. That's basically the downside adjustments. If we get much below the middle, like maybe down to here or something, I might not even just stay in the trade. It will mean the market has moved quite a bit in a very short period of time, and it may not be worth it to stay in the trade. Okay. And also note that taking off these put credits actually lowers the margin. So I'm actually paring the trade down as it goes against me to the downside, which is always a good idea. All right. Question, do I try to maintain some negative delta on the upside after adjustment? On the upside, well, I'm wanting pretty close to zero, maybe even a bit negative after I make this adjustment to the downside, so I have more room to the downside. If the market reverses and goes back up, at some point I'm going to have to do something, or I'm going to get into a situation that I can't recover from. What is that? Now it's starting to get a little less clean. I can add back some of these put credit spreads. I can add back some at a higher strike, which is probably what I'd have to do because time is wasted away and I can't get too much credit for them this far out of the money anymore. I can roll up some of these bottom ones. There's a number of things that can be done. Should they be done? You know, I try to keep it as simple as I can. And in these situations, I might try to wait a little bit and see if it's going to get out up in here. If I don't think it's going to go up into here, then I'm okay to stay here because the tent is so high, and day by day it'll get closer to that. Okay. Target exit is 2 to 3 days before expiration. I don't want to expire these, but I will if I have to. And in fact, my current live trade, I am going to expire it tomorrow, but I have fixed it so that I can safely do that. And I'll share that trade with you in a minute. Those are the basics of the boxcar. It's not a complicated trade. It can get complicated if you want to fight it and do all kinds of fancy things like adding call credit spreads or calendars or iron condors. You can do anything, you know, to add credit and change the graph. We have a lot of tools in our toolbox, but if you want to keep it simple and a fairly simple strategy, then just do what I've outlined here. And most of the time that should produce a decent profit. Okay. I need to have mentioned one more thing that I forgot, which is standard deviation. We lesser criteria than that ratio I talked about, but still a criteria for me anyway, is standard deviation. I want the shorts on my put credit spread to be a standard deviation or more out of the money. If I do all that workup and they come out to be right here, I have to think long and hard about whether I really want to do that or not, or whether I want to get outside of a standard deviation. And it's just for safety. You know, standard deviation is 6 to 8% and all that stuff, but it's probably safe to keep that at or beyond one standard deviation away from the money. Okay, and let's see. Oh, good question. Standard deviation for how many days? Exactly. When I open a trade, let me clean up all these adjustments. I am going to expect my exit date to be 2 to 3 days before expiration. And so that's what I calculate standard deviation for. And the way I do that is I'll set this up here to 2 to 3 days before expiration, which would be about June 4th. That'd be a week from tomorrow. And making sure that this is on the opening day. And I see right away that here's a standard deviation. If I did that right. I think I did that right. Oh, I need to unlock, yeah. So it's way down here. So these particular strikes aren't going to be a standard deviation out of the money. Down here would be. Right. Okay. Why use a put debit spread instead of a call credit spread? Would get the same payoff. So there's, I mean, you certainly can. A call credit spread has negative delta, just like a put debit spread does. Would you get the same payoff? And would you get it in the same time frame? A call credit spread, you get a certain amount of credit, say $1 credit, which raises all the lines. You now have this dent in the graph wherever the shorts of the call credit spread are. And if you think about as the market goes down, a call credit spread isn't going to pay off as fast as an equivalent put debit spread. Why is that? Because the put debit spread is going in the money, and it's going to go up in value quickly and have less extrinsic value as it goes in the money. And a call credit spread will be going further out of the money, and therefore the only way that you realize that credit is through theta decay, you know, and that takes time. And likely if you sold it for $100, you won't realize $80 or $90 of that premium until you get to 2 or 3 days to expiration, which is actually my target exit date. So it won't do me too much good. Those are all good reasons, but the main reason I don't do it anymore is because, you know, I was doing road trips and some other stuff. I got hit on the upside all the time when I did call credit spreads, and it messed up a number of trades because the market goes up more than it goes down, at least consistently. And the call credit spreads got into trouble, turned into losses, and took away my profits. So I tend not to do them anymore for that reason alone. If I do them, it'd be with only a couple days left to go, and still really far out, like 5 delta, 6 delta or something for the short, and then only if I get enough credit for it, which is for me more than 30 cents or something like that on a small trade. So I think that's my answer to your question. You can definitely do it, but it's not quite the same, and it doesn't work in as well for me. Okay. Great questions, you guys. Thank you. Legging in to get a risk-free trade. Okay. You can do that. And if it works the way you want it to work, in other words, if the market does what you want it to do while you're legging in, you can get a risk-free trade. You can get credit. You can greatly change the dynamics of the trade. But that depends on it doing what you want it to do. And if it doesn't do what you want it to do, then it actually can hurt you. So I tend not to do that, but it can definitely be done. I tend to try to enter these as a condor order if they'll take it. If they won't take it, or if they want me to cave in too much to do it, I'll do it as 2 spreads like this, as close together in time as I can. And I usually do, I usually want to do the put credit spread first if I can take that much margin before I add the debit spread, because that's the credit that I want to be sure that I get. You know, the debit spread is whatever it is. It's just a hedge. Let's see, puts probably have better liquidity below the market. That's all true as well. There can be liquidity problems. And I didn't talk about that, but that's another relatively minor criteria we have, is look at open interest and volume. Now, volume starts at 0 at the beginning of the day. So if you're doing this in the first 5 minutes of the day, volume is going to be low anyway. But if you're doing it late in the day, you'll be able to see if there's enough volume. But open interest is a better indicator from that point of view. Want to see, I don't know, 40, 50 open interest, maybe more, something like that. This one has a lot right here, especially on the put credit spread part. I want to see good open interest on the short and the long if I can get it, but especially the short, so that I get good pricing, good execution, and all those things. You find in the Russell, you find all the time there's like 5 open interests or 10 open interests, and that pretty much makes it so you can't do this in the Russell quite so easily as you can in the SPX. Okay, more questions, and I have another topic before I'm done, so hang on, I'm going really fast. I think we're gonna make it. Let's see, how often do I leg in? More than 50%? Definitely not. I don't leg in more than 50% of the time. If I had to guess, I would guess maybe 5% of the time. I really would rather not be doing that. Time after time, I see it go the wrong way, and people simply lose the trade right at the start because they didn't get the pricing that they would have got had it been a condor or spread order all at once. Oh, Wayne, thank you, kind words. Good, I hope this is all helpful. The confluence criteria seem really intelligent. Can you repeat your assessment criteria for upside confluence in a step graph at the end of your talk? I will. I can't take credit for it. Dan Harvey pioneered that. I'll be honest, I never had used the day steps before Dan Harvey came up with it. And even then I thought, well, I don't know if I like that, but I've come to really like it and respect it. It's a brilliant way of doing it. So yeah, hang on, I'll get to that. But I have another topic and another slide I have to get into before I'm done. Let me find it. I'm looking at the participant list and I'm looking to see if Gary Whitlock is here. Gary, I saw you earlier. I don't see you now. Maybe
I
stepped
see
out.
him on there.
Oh, he's here. Okay. So Gary, I'm not going to call on you. I think we'd run on time, but I want to talk about the B tool a little bit. And those of you who used to trade the road trip might remember Gary developed something that we called the G tool with the road trip. And it was a programmatic way of doing all this criterion analysis and ranking of a whole bunch of possible trades for entry. He's done that, or he's doing it for the Boxcar, and I wanted to just show you briefly what it's going to do for you. It's something that I think he's going to release pretty soon. Um, it might be a minor subscription. I'm not sure how that's going to work, but I made a slide. Where did I put it is the question. Oh, is this it? This is it. Okay. This is a sample of the printout that the B tool does. And Gary, I hope it's okay that I show this, but it's excellent work. This is an excerpt of it, but it does all this analysis and it has ranked them in order of, I think, profitability, expected profitability. And it has found this trade here. This was done this morning. 4 lot of the put credit spread here against a 2 lot of the debit spread here. And here's the strikes and what it would all cost. That ratio that I talked about is right here. This one has 0.77. Some things about margin before and after you have to make adjustments, and delta and vega and theta and all that stuff. This is, if on the day that I'm opening a trade, I can look at this and I can scan the first top 10 or as many of them as I want to and find one that I like that fits at the time. And this has done probably 90% of the analysis for the entry of a trade. Then furthermore, Gary has nicely put, oh shoot, get that back. This line, this top line here, if you copy this, you can paste it into TOS as an order and then submit the order. Same with the next 2 lines. These are the adjustment points based on some criteria that we came up with, which is basically what I said, although it's done programmatically. You can paste these into Thinkorswim as well and get your good to cancel orders to automatically do the first adjustment points. It's an excellent tool. It's well worth whatever he wants for it, and it's going to turn out to be indispensable for this trade, just like it did for the road trip. So thank you, Gary. Excellent work, and we're really glad you did that. Okay, that is my presentation. There's a couple of things I deferred, so let me get back to them. There was one way in the beginning. Let's see. Okay, Matthew. And Matthew, I got your email. This is the same question you asked me in email, and I was going to type it up after this, but let's talk about that for a second. Question is, can you discuss getting trades filled with your broker? Tried to trade a 10 by 20 in SPY, and it wouldn't fill. Okay, couple things. SPY is the ETF on the SPX, and it's basically 1/10 of the SPX. It's going to have less premium strike for strike, which means you have to do a bigger lot size, which means you have bigger commissions. And in the past, when I looked at doing butterflies in SPY versus SPX, so for example, a 10 lot butterfly in the SPY or a 1 lot in the SPX, I found that the commissions ate it up and there wasn't any profitability left in the trade. So that's why I don't do it in SPY, but it certainly can be done. SPY has the liquidity. Everything would work the same way it does. You'd have to adjust how wide things are because SPY is 1/10 of the S&P index. But your question is about fills. So if you're trying to fill this as a condor order, that's a 4-legged complex order. And if it's also unbalanced, if there's like 2 credit spreads to 1 debit spread. So that's 2 strikes against it. It's called a complex order, and they either want to get a lot over the mid price, or they won't even take it at all. And I find that even in the SPX sometimes, with these unbalanced complex orders, they won't even take them. So when that happens, I break it up into 2 spreads like you see on my screen here and execute that way. You'll have a much easier time executing 2 2-legged spreads than you will 1 4-legged unbalanced spread. Even then this week they wouldn't even take these, and I had to decide not to do that at all and go on to do something else. Different brokers are different. I've seen the same order be placed in at broker A and another order being placed at TOS, broker B. And I've seen the order at broker A fill when the order at TOS was in for the same price and it did not fill. I don't know the explanation for that, but there are differences in execution between brokers. That could be also another problem if they wouldn't fill it. If you cave enough, they'll fill it no matter what it is, but you might have to cave $1 or more, and that would actually probably blow the trade. So I definitely wouldn't do that. I guess that's my answer to your question there. If there's more, you know, let me know. I can talk about it more. Send me a mail or something. Let's go down in the list here. Oh yeah. Oh, Gary, yeah, it says thanks for the nice comments. Gary, what you do is priceless. I can't say that enough. So thank you very much. Okay, Steven says the confluence criteria seem really intelligent. Can you repeat your assessment criteria for upside confluence? Okay, all right. Let's do that real quick. Let's see here, get my risk graph. We'll go to the day steps. I'll do 4 day steps at 2 steps a day, right? And let me try to expand this vertically a little bit. Okay. So I know it's subjective. This is not scientific, precise criteria, you know, but to the downside, we're looking for an adjustment before it gets bad. And it's going to start to get bad when these curves tail off or start to turn down. Okay. Now notice this one, the furthest one out turns down later than this one does, later than this one, later than this one. So I don't want to pick this. This is expiration day. I really don't want to let it get that bad. That'd be really bad on the T+0 line. So I pick a line that's either 2 or 3 days out, something like that, to help me pick my first adjustment point to the downside. And if that's this line, which is May 31st, which is Monday, see how the flat part of it is here, and here it's starting to tail off. And I look at that and I say, right about here is where I want my first adjustment point, knowing that it'll actually be worse than it shows because of the volatility spike. And then once again, I got 41.75 or so, okay? And then I usually bump that up about 5 points just to be even safer. This is actually a little bit later than Dan chooses. He would probably choose up in here somewhere. And there's nothing wrong with that either. To the upside, it's a little bit subjective as well. You can see that if you think about the difference between these lines, this is P&L difference between these lines. And up here, there's no difference between them. By the time we got way up into here, it doesn't matter. You know, you're going to lose. you're outside the profitability zone of the trade. So you need to pick a point somewhere. And I pick a point. It's tailing off clear from here, but I pick a point, I guess I would say a ways down from where it's beyond repair. How far? I usually like to pick this, and if you look at these, you'll find that you can pretty much have a good feel or pretty much pick something in here every time. Now, would I say 42.15? Again, I would come down a little bit from where I pick from the graph and choose that. So 42.15, 42.20, 15 might be a little bit early. In Gary's tool, we found a programmatic way to do that, which is basically 15% of a standard deviation from the current market at open for the upside adjustment, and that's where his orders are generated from, and 25% of a standard deviation down from the market at open for the downside adjustment. Those are initial adjustments, by the way. I will always reevaluate them a day or two into the trade because they change day by day. So you can't set it and forget it. Maybe that doesn't help very much, but that's kind of how I use the day step graphs. Dan has talked about that a lot in Trading Group 1. but I think it's a really good way to visualize how your trade's gonna look pretty easily. Wow. Commission is not an issue. Okay, fair enough. Yep. It seems like I would be lagging way more than 5% of the time. So if you were talking about lagging into the trade on open, yeah, 5% or less is how often I do that, which is almost never. I don't really recommend it. If you're talking about getting out, you can leg out as well. I do that occasionally, maybe 10% of the time. But again, you can still hurt yourself if the market moves between when you get your orders done. I'll show you my trade, and then I guess I'll stop there. Is this recording going to be made up on Aeromir? I think so. I'm pretty sure it is. Should you making vol adjustment and looking at peeling off spreads? Technically, you should, because these graphs don't show that. I guess by me picking a point and then adjusting it 5 or 10 points closer than that point is my way of attempting to handle the vol spike that would happen. There's no good scientific way to do that because in the end, you're always estimating what the vol spike would be in a downturn. Don says, yes, the recording will be both on group website and Aeromir. Okay, great. Would I always try to adjust before delta going positive on the downside? Not necessarily. Not necessarily. I would instead use these day curves more to pick a downside adjustment point. We talked about having between negative 1.5 position delta and 0.5 position delta on open. I'm not sure I would try to maintain that range during the trade. I think I'd rather pick the points using this kind of analysis. Oh yeah, superimpose graphs, okay. And my current trade. Okay, Don, if I can have maybe 5 more minutes, I'll do that.
Oh, you can have a lot more than that.
Okay, good, good. I wanna be sure I don't, go too long. Let me clean this graph up. How about my current trade first? I'll show you that. I have to find it. Let's see. It's this one. It's this one. Is it this one? Yeah, it's this one. Okay. I have so many saved simulations. I have to be sure I get the right one. So here you can. I opened this trade last Friday. You can see that this is these calendars don't count. They're in there just because I'm monitoring. So this is everything I've done to this trade since I opened it. The Condor order was the opening. It was an unbalanced Condor 3x7 based on all the analysis I showed you, and I paid $1.30 for it. If I uncheck everything since then, this is what it looked like on open. And the SPX was at, let's see, where was SPX when I opened that? It was at 4167 right here. Okay, now we're at 4200, we've gone up. So as the market started going up, I had to peel off some of these debit spreads. And if I remember right, the debit spread component of this cost me $1.64. Okay, you don't see that here because it was a four-legged order, but I wrote that down somewhere. I think it was $1.64. That means I had to sell these, and this line is below by $130. So I had to sell up to 3 of them for say $230 to $300, which means I really need to sell these for on average $1 or more if I want to get that line above zero far enough to make decent profit. So so you could pick your upside adjustment based on that alone. Do it when they're about $1.20 or something, and then maybe 90 cents, and then 80 cents, something like that. But I didn't. I used the day step curves for these, and I don't remember where SPX was when I did this, but I sold the first one for $1, which made the graph look like this, and we were up in here somewhere. But I'm still $15 below zero on the line, and we're way outside the tent to the upside. Then it went up some more, about another 10 points, as I remember. I sold the second one for 80 cents. So think about what is the average of these two numbers. It's 95, it's about 98 cents or something like that. I just barely made my goal here. And then the graph was only 65. that would be just over 2%, which, you know, I'd like to get more. You know, this was a $2,500 trade when I started. Now it's gone up since I took off those debit spreads. And the market still went up. And I thought, well, what can I do? Well, this is where you get out your toolkit and you say, there's 15 different kinds of things I could do. What do I want to do? I did a lot of analysis. This was 2 days ago, if I remember right. Or maybe this was yesterday. I ended up doing this here, which was, I could take off this debit spread, the original debit spread, for whatever I could take it off for, and I could buy another one further down for less. I mean, think about it. It's further out of the money. It's a put debit spread. It's going to cost less than the one that's higher, even though they're both out of the money because the market's way up here. And it turns out by doing that, I got 30 cents credit. So I put a condor order in and executed a condor order to roll that debit spread down. And if we check that, you can see the debit spread came down. I didn't want to have just a put credit spread with no hedge on it. I just didn't feel comfortable having that. I wanted to have at least some kind of a debit spread in front in case of a big drop and be a little safer than just a put spread. Now, in my personal account and under other circumstances, I might have just done the put credit spread. Sometimes I'm more aggressive with those, but this one I wanted to be really safe. So I did this. I got that credit that raised the line now to $95, which is a little over 3%, 3.5% or something. And since this expires tomorrow and I'm at least 140 points out of the money, I felt that it was pretty safe to try to expire this. And so far, so good. And that's my plan at this point. I could do a condor order to close this whole thing, but that would involve 2 contracts for the debit spread to close and 14 contracts for the put credit spread to be closed, okay? That's 16 contracts and that adds up some commission. And if this trade had been scaled up to, you know, a 20 by 30 or something, that'd be a lot of commission. Being 2 days or less to expiration and 140 points out, I thought I'm just going to save that commission among other things and let this expire for $95. And that's the plan. If everything goes to pieces tonight, somewhere down in here, let me change this to tomorrow, somewhere down in here, I'll simply exit the trade for whatever profit I have left at that point. But that'd be down around 4,100, 4,110. You know, that's 100 points away. So it could happen, but there won't be any more adjustments because it's too late. It's just exit. Okay, so that's my current trade. And now, lastly, let me just show you what I did with those graphs. Here, let me get it back on my screen. Wrong one, okay. Was it this one? It was this one, okay. And let me show it to you. Okay, here's that superimposed graph. How'd I do it? This is not done in TOS. This is done in PowerPoint. And if I bring PowerPoint over here, I have the 2 graphs stacked right on top of each other. And the top one, I format picture and click on picture here and you can set the transparency and I set it to 50% transparency. You can see if I didn't do that, then you wouldn't see the butterfly below it. And if I made it 100%, you wouldn't see the boxcar on top of it. So 50, that's all I did to show that graph. So it's a trick and it looks like it was in TOS, but I did not do it in TOS. Okay, so there you go. You know, I'll tell you a brief story. My last job, which I quit the job world in 2011, but my last job, I was managing a project, a software project, and we wanted to have a little indicator of how many of the tasks were being completed and stuff like that. So I made this little thermometer. You've probably seen this before with fundraisers, right? They have a thermometer and the more funds they raise or the more tasks got completed on my project, the higher the red mercury or the red fluid went in the thermometer. And I automated all this. And everybody thought, that's really cool. How did you ever possibly do that? And it turns out it was a little bit of trickery similar to this, but it was not complicated at all, but it's very impressive. So I got a lot of kudos points for being fancy when in fact it was not really a big deal. there is a way to do it in toss, I wouldn't be surprised. And if I thought about it, I might be able to figure that out myself. But I didn't actually do it in toss. I know you can put, you know, you can put two simulations up and show the graphs. That's probably, but that's not exactly the same thing. That would look like this. This is the combined graph if both those trades are on. But well, I wouldn't be surprised. There's probably a way to do it. Yeah. So, okay, well, sorry I didn't make a whole bunch of good slides like I did last time, but I really enjoyed talking with you guys, and
Oh, this is great to actually, people really like looking at the actual trade.
yeah.
And I like the depth you exchanged it, you discussed it with. Let me ask, I think we have time for some, well, we do have time for some questions,
Okay.
particularly, you know, some people might want to ask them out loud. Let me ask one to start, if I may. The most, as the market moves up and down, let's suppose you're in the middle area of the trade. Is the basic idea, is this the case, that the basic idea is that we're worried about going too far down, so we cut back on the credit spreads if we start moving too far down? And on the other hand, if we start moving too high up, we cut back on the debit spreads because we're worried about them losing value.
That's right. It's basic risk management. You know, as you want to take off the one that's hurting you, right? And so here's just the debit spread. You can see right away as it goes up, it's hurting. So at some point, at some reasonable point, you want to take it off so it doesn't hurt you anymore, yet still have a trade that is has profit potential.
And I see that Steve Polensky says that's, perhaps he's suggesting that's equivalent to flattening delta. Would you agree with that?
I pretty much agree with that. But not completely. And the reason I say that is this. In Boxcar, yeah, pretty much I agree. But in some other strategies, we might let the delta get to be positive 20 or something, and you don't want to take off whatever's hurting you all the way to get your delta down to 0, because that's a major adjustment, right? And so my strategy, I'm thinking about road trip here, was always, if the delta is 20, yeah, I want to cut my delta, but I don't want to change the sign of it. I might not even want to go to 0, so I might cut it at least in half, and that was always my guideline there, is to cut it at least in half.
Okay, somebody else, please turn on their mic and ask something that would be a significant issue. Or do people understand this basic trade? Would anyone care to paraphrase their version or their view of this trade? And while they're doing that, oh, let me see here. Steve Polensky says, yes, I found cutting delta is in half is good as well. So he's agreeing with that. In other words, we're allowing for the possibility that it might reverse again.
That's right.
And how does that compare with other trades, like other strategies? Are they taking, do you find a similar pattern there of reducing the longs when it starts getting higher up and reducing the shorts when it goes further down? Does that carry over to other strategies as well?
Well, so think about road trip for a minute, because I traded a lot of road trip trades. We typically would, instead of taking stuff off, we would typically try to add credit somehow while still controlling the delta or still making an adjustment that widens the tent for me, right?
Mm-hmm.
But the difference is road trip was always 60 to 85 days to expiration, and you had 40 or 50 days to do that. These are much closer to expiration. And the closer you get to expiration, the less ability you have to add credit like that and make it work. So even in road trip, I always used to say, if you get below about 25 days expiration, whatever you do when you're making adjustments, start paring the trade down, which is exactly what these adjustments do here. So I think that's the reason that they're much shorter duration trade.
Oh, I see. I know that this is sort of another version of some of the original trades that that were similar, like Weirdor that
Yeah.
Dan Harvey had, but it takes out the upside, the calls side of that. Would you agree with that, or?
Yeah, I would. And in fact, if you think about the graph, this is just about exactly half a Weirdor, right?
Yeah, exactly.
um, so, um, one of the golden rules that I trade by or memorize or advocate is when the market goes up, you want to buy calls and sell puts. Okay. And that doesn't mean just buying long calls or buying or selling long puts. That means in whatever form it is. Is it a spread? Is it even a butterfly? There's all different forms of buying calls and selling puts. But that's what that adjustment is. Market goes up, you buy back some of the call credit spreads, you're buying calls, right? And so a lot of times people will do both. Market's going up, I want to take off the calls because that's hurt me. At the same time, I want to sell puts because they will also benefit in an up market. And that's a perfectly good way to do an adjustment as well. Don't usually do this on the boxcar because I think we're trying to keep it simple and we don't want to grow the margin and all those things. But
I have
yeah,
a comment about the boxcar.
yeah.
Go ahead. Is that Wayne? That's Wayne, right?
No, this is Bill.
Okay, Bill, go ahead.
I've been trading the boxcar for several months, and here's a key point that Tim has alluded to, but let me say it in my words.
Okay.
A lot of the butterflies and condor variations that we've traded over the years, the basic MO was to fight the trade to the death. And that's not the case with the boxcar.
Right.
You adjust the trade, you adjust it fairly early, and because it's such a short duration trade, your objective is a fairly modest profit target. But when you reach that target, you get out, and if you've had to adjust it a couple of times and it's still not working for you, you just close it and go on to the next boxcar.
That's
And
right.
that's quite a different mindset. It took me a little while to get there.
Right. And I might add too, think about all the times you did fight a trade, road trip or M3 or anything else. Did it work? It still often didn't work even so, So
Exactly.
yeah. Yeah, that's a very good, concise summary of what we're doing here.
Wayne, did you have a point? Your mic is on. Maybe it's just accidental. I guess one other question. I noticed when Amy trades some of these strategies, I don't know specifically how she traded the boxcar, but in general, in a lot of her strategies, she puts in just-in-time sort of orders to open orders to place trades, particularly long trades, just below the money to hedge if the market moves down.
Yes.
In other words, to preserve the hedging capability that we sort of lose as the market moves below the debit spread initially. Do you also do that kind of thing?
Yes, I didn't talk about that, but this is a key thing to the way Dan is trading the boxcar, and I want to trade it. I'll tell you why I say I want to trade that way, because I can't actually. But that's exactly right. When you open the trade, immediately put in good to cancel orders at your upside adjustment point, which I call the UAP, and your downside adjustment point, the LAP, lower adjustment point, as determined by whatever means you determine, be it 0.25 standard deviation move down or the day step curves, and get those orders in there because you're going to be sleeping in late and it's going to happen at market open, and this will help you not miss an adjustment. The other thing is if I have a trade, okay, so this is most of my live trade, right? I don't have that roll down debit spread in here. But if I have a trade like this, I am always going to build a closing order And in this case, it'd simply be a condor. It'd be a condor with one lot debit spread. See that? If that executed, I have a flat line. I'm going to pick a price at which I make my profit target, and I'm going to put that order in and let it sit. Because once in a while you get a gift horse, or once in a while that'll fill while you're sleeping, or even while you're getting lunch, or whatever, and you have exited the trade and you didn't have to do anything manually. Now you have to manage that order. I mean, it changes day by day probably where you want it to go, but I'll put those orders into and let them sit. So it automates it as much as you can. Now I said I want to do that because I trade a lot of these at Charles Schwab. That's where some of my accounts are. And Schwab does not let you, I can't believe this, and I'm going to ask them to fix it, but I can't believe it. They don't let you put in conditional orders based on a price of the underlying for spreads.
Yeah.
You can do singles, but you can't do spreads. And I'm like, that is so stupid. I mean, TOS lets you do that, right? But maybe there's other brokers that don't as well. And so if you're trading with a broker that doesn't let you do that, this part doesn't work. What I do then is I set up alerts, so if the price gets to wherever that was going to be, then I get a message on my phone and I run back to the computer or whatever and try to execute it manually.
Sure.
Yeah.
So you can do it that way too.
Yeah. But yeah, those are an excellent thing to do, especially in the boxcar trade.
Who else has any questions? Do you get the basic? Do people get the basic idea? And that's your chance to ask Tim if you don't.
Oh, Matthew's got one. Once you get torched on a market order, okay, right. I don't put those good till cancel orders in as market orders. I never do market orders with options. Well, okay, 0.1% of the time on my covered calls I do, but that's a whole different story. I would not put these in at market orders. That means that you have to pick an offset from the mid price that you think is reasonable that they'll take at the time, and that's a guessing game. So you can say 5 cents over the mid, they might take it, they might not, depending on what's going on. You could say 20 cents over the mid, there's a higher chance they'll take it, but even then they might not. And so I usually pick something like 20 cents or even 25 cents. You've got a really high chance there. If you really want to be sure that it's going to execute without making it a market order, you can put it in at the ask. At least TOS will let you do this. You can say, put it in at the ask price at the time, and there's almost guaranteed that you'll get a fill.
Yeah.
It'll be away from the mid, but it won't be like a market order. Market order could be $1 or $2 away from the mid. I've had that happen. But if you put it in at the ask, it might be 30 cents, but at least you got your adjustment done on time,
Have you tried routing your orders to different exchanges?
I haven't tried that for a long time, and not with boxcars or anything like that. I did play around with that on the Russell when I was doing M3s and stuff. I didn't find much difference in trying that, but
Okay.
it's possible, yeah.
Tell us, I mean, we should be fair to you and to Tom, and you are offering a service for a fee, which is gives out the alerts. How is that coming along?
Okay, so I've been doing it since May 7th, so it's not very long yet. I'm on my third trade. The one I showed you is my third trade. It'll come off tomorrow for decent profit. So I'm feeling okay. My first trade was a loser. My second trade was basically break even. We had all that market action in the last 2 weeks, and that's what took out this trade, and that'll take out most trades, So then it becomes a matter of how did you handle it and how well did you limit the risk. But the service is an educational service at its root, okay? And so I'm trying to do everything I did here. I'm trying to lay out mail. I'm trying to show my thought process. I'm trying to show why I decided one thing and not another thing. That's the educational part of it. The basics of Boxcar, or even the entry and everything, is all public domain. Dan's talked about in Training Group 1 and everything. And so I feel the education part, what you get in the service is you get the thought process at the time and why I chose what I chose, as well as getting an alert or a message whenever I make an adjustment on my trade or whenever I enter one. You get it within a minute of it. That's the service. I'm happy doing it.
And you offer mentoring as well, I believe.
I have done mentoring. I haven't done any for a while, although
Okay.
I now have a mentoring student. We'll be working on various things. I taught a lot of the road trip. I really like to teach beginners or people who need to learn fundamentals or whatever, you know. But yeah, I do that. Yes.
Yeah, we should mention that Tim is one of the most generous presenters and educators in the industry because he's giving talks like this, and he also has his own beginners and small account group every week. A lot of us follow that and look at most of those. That's a whole service, and it's only that one is for free.
Yeah. Tom and I have a little disagreement on that. I think it's the longest running group that is on Aeromir. He thinks the trading group one is a little bit longer, and he's probably right, but I think I have the longest running group.
Well, there was, oh boy, we could go into the history of trading group 2.
Yeah, right.
But so how much does it cost to get this the paid service? Or if you don't want to go into that, that's fine too. But
yeah. I think it's $99 a month.
Okay, and that's very reasonable, and people could try it out for a month or see if they like it.
Half price for the first month. Yeah.
Yeah. Half price, all the better.
Yeah.
And to do that, they go to aeromir.com/ let me guess, Boxcar, something
Probably,
like that.
I don't actually know. So, you know, because Tom does all that stuff,
Yeah,
but I think you're
probably.
correct. Yeah, there's somewhere out there where you can.
Yeah,
I'm trying to
try here.
log in here. I might not even see it either because I'm logged in and I have permissions and everything, so I'm not even sure.
Does somebody want to try it and let us know what the URL is? I bet you it's /Boxcar.
I'll try that. Aeromir.com/boxcar.
Yeah, but I think there's a typo there.
Oh, did I do it wrong?
Oh, there it is. Yeah, so aeromir.com/boxcar to find out more about the service here and a little bit more about the trade. You can go back over this video. You can look at other videos that Tim has done, and I think he probably put a lot of educational material out into the service.
I do.
Probably more than any other service. So it's probably one of the best opportunities if you want to try a service.
Also, in my beginner group, I've talked about it quite a bit, and over the last 3 or 4 months, many sessions I've spent talking about Boxcar quite a bit, and those are all free in the library. So,
yeah. I see one more question, and then we'll have to let it go. But do you look at the VIX range from Mark? Do you look at the VIX range before deciding on putting on a Boxcar?
So I'm not sure what you mean by VIX range, but if you're talking about the VIX, no, I don't, but let me comment on that for a second. Dan has said, and I tend to agree with him, that boxcars are best put on down days, you know, because there's a rise in volatility and all that stuff, and you get more for the same strike in your puts. But I think it's not bad to put it on a flat day or even a moderate up day. A big up day, I definitely wouldn't put on, because put credit part will be cheaper premium, or you'll have to get closer to the money, but the debit spread part will be cheaper as well, you know, and so there's a bit of a balancing act there. You know, now you typically have a ratio of 2 to 1, so what's probably more important is the down day, because that's where you get more premium on your 2 out of the puts, right? But there's a balancing act there. So I don't exclusively wait for a down day to put them on, but I wouldn't put them on a big up day.
Fantastic. Well, unless there's anything else that you wanted to add, and we'll move on to our other presentation. Thank you so much. We really appreciate all your work.
Well, you guys are fun, and someday, boy, I hope that I can travel out there and see you guys in person, you know?
Oh, I
would like to do that.
Hope we get the chance. Thank you very much.
I will stay around. I'd like to hear the next guy. So thank you very much. And